Okay.
Okay, so we'll do some tax charity now, and that will be great. All right, so it's tax time, and it's it's probably too late to give to charity at this juncture, but you might want to prepare for the next year. That's what I'm thinking we're going to do. John Bever, president of Phase 3 Advisory Services, a registered investment advisory firm. Good to have you with us.
It's great to
So
be here.
thank you. Thank you. Are there any changes to charity deductions this year that we need to know about?
No real changes, but there are some strategies that people should keep in mind. And giving is actually up, even in spite of the pandemic. 2020 saw charitable donations increase by Americans by about 5% compared to the previous year. And in 2021, another 4% increase. So giving is popular. What I recommend people do, though, is to be intentional, first of all, before doing anything else. Think about how you want to give and plan your giving early in the year, not necessarily late in the year. You may give at the end, but plan early. And if you've got a family, I would include the family. Write out your goal, and this will help you find the most tax benefits.
Oh, I like that. All right. So I understand there are some tax thresholds.
Yes, so you need to be aware of your tax thresholds for the year. This primarily relates to your itemized deductions. So for 2023, singles can itemize if their itemized deductions exceed $13,850. For joint, it's $27,700. So you want to look at how close you are to itemizing. If you're way below and your charitable contributions are not even going to push you up to the point of itemizing, you need to think about your strategy. You still may want to give for the charitable reasons, but if you're doing it simply for the taxes, you might want to look at doing it in a different way so that you can get that deduction. One way is to bunch, another way is to use qualified charitable distributions. Another thing you should look at, though, is also that your standard deduction is going to reduce in 2025. Current tax law is going to sunset at the end of 2024. So you're going to see those standard deductions reduce, which means you may be able to itemize a couple of years from now where you cannot itemize right now. The other thing is, if you are a senior, you're over 65, you're on Medicare, you have to be aware of also what your adjusted gross income is, because that can affect your Medicare premium. If you go over certain thresholds, that's called the IRMAA brackets, IRMAA, and you really don't want to go into that next bracket. So that's where using a qualified charitable distribution can be helpful.
John, what if somebody has been giving stock donations? What do they need to know?
So what you need to know is you're really going to benefit from that if you have long-term capital gains. So if you've held the position for less than a year, don't use that asset. And you want to use the most appreciated assets, because when you give gifts of appreciated stock or even private business ownership or even real estate, you can avoid the tax on the capital gain, which is a great advantage. Also, by not selling that asset, you're not recognizing that income on your tax return and increasing your adjusted gross income. So you want to look at what long-term capital gains you have, how large they are, and match up your donation to an asset that would work to give you the dollar amount that you want to give to charity. And you can give this directly to the charity, but you can also use a donor advised fund, which if you're giving a large amount, you might want to grant to charity over time as opposed to all at once.
Excellent. Thank you, John. Always good information. We appreciate you.
You're welcome.